people will keep joining us, and the recording is available on our website and it's quite extensively tapped and used. So I think it's time we can start now. What I'm going to do is, I'm just going to, as we have discussed briefly, introduce the two speakers and hand it over to them. The issues are very, very important. There's so much to talk. So then they will take forward as they decide amongst themselves. So
you have to just remind us where to stop, huh?
Yeah.
I suggest we can be slightly flexible on timing.
Absolutely, we are flexible, and you take a call. There are questions which will come on the screen. You can take a call as and when you decide. So totally flexible. Totally flexible.
Yeah, our preference is to take the questions at the end, if it's okay with you.
Sure, I'll make that an agreement.
Yeah.
But people keep joining throughout the seminar, so some of them go, and you can then tell them, and I can also tell them. Okay, so what I'm suggesting, Vivek, can we start now? Are you ready for the recording? Yes, okay. So good evenings, everybody. Welcome to the EGROW Friday webinar series. We have been doing this for a long time now. Every Friday, 5:30 to 6:30, even up till 7, we have this webinar series where we get the best minds in the country to come and speak to us on policy issues relevant for our country basically, or relevant to the basic economic issues that are prevailing across the world. So today's topic that we have chosen is on the banking sector. As you know, the country is passing through the COVID time, and once the COVID opens, then how's the banking going to adapt to it or take it? Those are very, very big burning issues that we all need to know about. So who could be the best to speak on than the two former CMDs? So the topic for the day is contemporary issues in banking, looking forward, and we requested two CMDs, Mr. Upendra Kamat, former CMD Vijaya Bank, and Mr. Mohan Vasan Tangsale, former CMD Central Bank of India. We requested both of them if they can come and unveil the issues before us, so that we as thinkers, analysts, scholars, policymakers can develop on their experience and get prepared for what is there ahead of us as banking is concerned. My request to you is please mute your mics so that everybody is not disturbed. Please mute your mics, all of you. I've just spoken to the speakers. They will be handling the session on their own. I'm just going to hand over to both of them, and then the way they want to conduct is totally on their own. And the question answers they would prefer to take at the end once they have finished their presentation. So let's respect their view of that. And then at the end, once answers are over, they'll hand it over back to me. So I'm now going to hand over the mic to Mr. Tangsale as well as Mr. Kamath to take the proceedings further. Thank you.
Thank you, Mr. Charan Singh. Well, good evening. From the screen, I can see that I got many former bankers who are part of the audience and the respected audience. At the outset, our sincere thanks to Mr. Charan Singh for giving us an opportunity to express our views on contemporary issues in looking ahead. And that too from the very august platform of EGROW Foundation, which actually contributes to the various policy initiatives. I have been witnessing the various events on the EGROW, and their contribution is immense. Hopefully, both of us will try to share our experience and will speak through our experience of over 4 decades in the banking industry. I will just tell you for the interest of the audience that both of us have started our career in early 70s and have been part of Union Bank of India for almost 35 years together. And thereafter, of course, we moved to different banks as ED, MD, and That's what it is. Kamath, having been in the industry for over 4 decades, we certainly admit that real time for the bank industry, aggravated by the impact of the pandemic globally. And it's we are truly in the what do you call the VUCA environment, where the volatility, the uncertainty, the complexity, the ambiguity, it's all persist. And with all this, I still strongly believe that given the strength of the banking industry, uh, I very strongly believe that uh, there should be a proper reversal, and therefore I will request you to, if you can, trace the journey of the Indian banking to start with.
At the outset, let me thank Professor Charan Singh sir for this opportunity to be on your webinar. Thanks, for this opportunity. Hi, Mohan.
Right.
It is but proper that we put our discussion in the right perspective. So that I would like to start from, tracing the journey of Indian banking, and then as we move forward, we can unfold on, various contemporary, topics. The history of Indian banking, dates back to 1770, when the very first bank, by the name of Bank of Hindustan, was established. Unfortunately, the same had to be folded up, liquidated in 1829. The oldest bank, which is existing even today, is the present, State Bank of India, which is its present, name, which was in fact started as Bank of Calcutta in the year 1809. Later, it was renamed as Bank of, Bengal. This was one of the three, uh, banks founded by the presidency government. Other two being, Bank of Bombay and Bank of Madras. All three banks were merged in the year 1921 to form the Imperial Bank of India. Post independence, Imperial Bank of India got to be renamed as State Bank of India in the year 1955. This is the historical perspective of, Indian banking. These three presidency banks, used to function as a quasi-central, bank in those times, till Reserve Bank of India was established in the year 1935 under the Reserve Bank of India Act. Most of the present public sector banks were established in the pre-independence era. Most of these banks were owned and controlled by business houses. This led to concentration of economic power in the hands of a few. The poor and the critical sectors of the economy did not have access to institutional credit at that point in time. Hence, Government of India rightly, in 1969, thought of nationalizing banks, and 14 banks were nationalized in the first batch, followed by 6 banks in the year 1980. Nationalization of banks, paved the way for opening large number of branches in the rural side. Critical sectors like agriculture, SSI, then what we used to call it as small scale industries, small business, self-employed, etc., got access to bank credit, and they were saved from the clutches of the money lenders who were very active, in those years. Development financial institutions like NABARD, Exim Bank, IFCI, SIDB, ICICI, and IDBI were set up at different points of time to spur industrialization and to give fillip to agriculture and to international trade. Subsequently, with a view to usher in competition and efficiency as a part of the banking reforms, Reserve Bank of India issued licenses to 10 banks Unfortunately, 4 of them are not in existence, today. In phase two, licenses were issued to Kotak Bank and to Yes Bank, and the latest to get license were IDFC First Bank and Bandhan Bank. Foreign banks were permitted to open branches and representative offices or as a wholly owned subsidiary in the meantime, in our country, and we have a fair bit of presence of these, foreign entities on the Indian banking, firmament. Latest addition to this, group is the payment bank and the small finance, banks. We have also, in the recent past, witnessed, consolidation of all the associate banks with State Bank of India and some of the public sector banks with larger, public sector banks, and we have gone through a phase of mergers and, consolidation. Recently, the internal working group of Reserve Bank of India has come out with some recommendations with regard to corporatization of banks. Now, these are at this stage only recommendations. Final decision will emerge, post the feedback, comments, opinions, suggestions, etc., which the Reserve Bank of India has now called for. As of now, it is only a recommendation. Mohan, with this we have come one full circle from private sector to nationalization, before nationalization, social control to nationalization, opening up of banking sector, to the private players, and now again back to corporatization of, banks. Now, this is the history of Indian banking in brief. Mohan, having taken our participants through the brief brief journey of the Indian banking, it is important that our participants do understand the important developments that took place in the banking in the past few decades. Mohan, could you throw some light on at least a few of the most important developments which in fact made Indian banking take to the next league to conform to the international standards, so on and so forth.
Thank you.
Mohan, over to you.
Thanks. I totally appreciate that. The audience should know the strength of the industry has come through evolution. And I always believe and state that the banking is rightly said to be a lifeline of the economy. And it has been proving it through the decades. What you are talking today probably has evolved over the period of time. Let me tell you, we are all talking about the inclusive growth today. I will refresh the memory of the participants that we have started the inclusive growth way back in 1973 when the differential rate of interest scheme came to lend at 4%. I was an officer to lend the money to a cobbler 2,500 at the rate of 4%. That was the beginning of the inclusive growth. Thereafter, all of you are fully aware that the lead bank scheme. Let me tell you, of the lead bank scheme has to be understood from a perspective that each and every district is owned by one of the bank, each and every state is owned by one of the bank, and collectively the growth of the district or the state is planned. And I think we have been leveraging through those tools with the help of Reserve Bank, with the help of NABARD over the period of time. But the real challenging time came the 1991 crisis, as all of us are aware that the results were negative. And we embarked on the initiatives of the liberalization, privatization, globalization. Now, all those initiatives which were rolled out had to be supported by the bank. And I'm very proud to say that the banking industry has supported all the initiatives of liberalization, privatization, and the globalization. I think all the export schemes were largely supported by the banks. The collection of funds from the non-residents under NRI, FCNR, NRNR, NR, we used to pay 17% interest, that is non-resident, non-repatriable. And that kind of beginning had happened. And today we are all proud to say that we got reserves of 500 billion plus. I think those are the things which we lived through. Thereafter, of course, with the privatization, when the new generation private sector bank came into being, all the public sector banks geared up to see that we are into competition. Thanks to the computerization which had already started in 1988 with the Rangarajan committee, I think most of the banks rolled out their core banking in mid 2000. By 2007 8, every bank was on a core banking. Every bank embarked on the alternate delivery channels from the early 2000, be it ATM, be it debit card, credit card, net banking, and thereafter followed by mobile banking, and then the various versions. And those things have really helped out the bank. I'll certainly like to add that the banks also got into the non-banking activities like distribution of the insurance products, the wealth management products, so on and so forth. And all those things. But the major game changer was when the PhDs were asked to go public. And I know that the bank started going public from late 90s, and almost every bank has gone public in a span of 5 to 7 years of time, raised substantial capital on a premium, even in those days. And from that, why I call it a game changer, the bankers learned that size is not the banking. It is the productivity, efficiency parameters, it is the soundness of the bank. These are very, very relevant when you are driving a bank. And I'm very, very happy that the banks have been focusing on this and have been driving the banking. And that has helped us in coming to a situation by 2008, we're all flush with funds. The NPAs were as low as 2% with the help of the various initiatives on the recoveries and one-time settlements and so on. And in 2008, the global meltdown happened. Again, in this situation, it is the banking industry. If all of you recall, there was a mandatory restructuring guideline coming from the Reserve Bank of India. And I think all the bankers have supported that. Not only that, the country was identified to have a deficiency in infrastructure projects, deficiency in the manufacturing capacities, and everything was supported by the banking industry during that time to keep the economy resilient and probably trying to see that the things really move in a right perspective. Having said that, Kamath, well, it is said that the things go wrong in a good time, and the credit creation was happening at the rate of 18% those days. We are today in the same situation when you are having a liquidity flush. The rate of interest scenario is as low as it was prevailing then. I remember the highest rate of interest or deposit in 2008 was 6%, and the lending was 8%. So we are in the similar situation. Having been in the similar situation, I would like to really have inputs from you that, as we say that it is the credit creation which is the multiplier for the economy, which helps in growing the GDP, which creates the employment, which drives the consumption. And I would like to have your inputs on how exactly in the given situation the bank should be pushing this agenda, which is a bread and butter for the bankers. You're on mute, Kamath.
Thank you, Mohan. It is true that, as you rightly said, the banking industry is flush with liquidity today. And there is a feeling, banks are not open to, credit dispensation, given the difficulties, that the banks are confronted with. The economy is not doing well, so on and so forth. But even in this, in the midst of all these issues, there is ample opportunities for the banks to, to grow on the credit, side. As on 22nd of November 2020, total advances of all banks, put together amounted to 104.34 lakh crores. YOY, it has grown from 98.60 lakh crores. Now, We are all aware that banks, extend credit to all viable economic activity. I underline the word viable economic activity, whether it is in agri, whether it is in MSME, corporates, infrastructure, retail, international trade, you name it. That is the bank's main, function. And I always say that lending is bank's dharma. I think, banker friends listening to me, will take this point well. Uh, and banks have indeed played a very important, very pivotal role in the economic development of our country, particularly the public sector banks. I am emphasizing particularly the public sector banks' contribution in rural development, in industrialization, in international trade, building world-class infrastructure in our country, etc., are indeed, praiseworthy. And we are all aware that credit expansion is linked to a few factors. One is the status of the economy, the current state of the domestic economy. The investment, climate both in the private as well as in the, public sector. If investments are there, credit will, automatically grow because projects need to be, funded. Expansion in the existing industrial capacity is another, vista for, credit expansion. And credit expansion, directly, indirectly is also linked to the global demand and global economic, growth. Our economy, domestic economy is driven by consumption. And therefore, consumption demand also is a driver for, credit growth. In the recent past, we are all aware that credit growth in the banking system is tepid. It is, subdued. Initially, due to the economic slowdown prior to February, 2020, and then now due to the impact of the pandemic. The FY 2020 credit growth was at a abysmally low level of 6.14 percent, and the latest growth is still less at 5.82%. I think our participants should also know what are the reasons for this subdued growth in credit in the banking industry. One, as I already mentioned, any hardly new large projects or large expansions, are happening. Hardly any. There is lower demand for working capital limit from the corporates, in view of lower capacity utilization. Many of the corporates, large corporates in particular, during this pandemic period, have deleveraged, themselves. They have reduced their debt levels. That is another reason why the credit is not, grown. And of course, there are competitions which the banking industry is facing from the NBFCs, from the HFCs, the microfinance institutions, and of course, latest to the list is the fintech companies. Retail credit growth is, hampered by the job losses, pay cuts, and the uncertainties, in general. Reserve Bank of India, as we are all aware, has injected substantial amount of liquidity, upwards of 10 to 11 lakh crores into the financial system, whether it is in the banks or whether it is in the NBFC sphere. But one thing that we must all realize is that economic growth and credit expansion are interdependent. Therefore, in the present context of economic slowdown and the impact of pandemic, opportunities for credit growth are not as high as it used to be in the boom period. Nevertheless, banks do have a responsibility to help business entities to survive, to revive, and to thrive. Let me, highlight a few vistas of opportunities available to the banking sector for credit growth. One, all banks, in my humble view, should be positively looking at meeting incremental credit needs, particularly of the MSMEs. They should also fund whatever limited expansion programs the MSMEs have. And banks in the same context should also fund adoption of technology by the MSME sector. This is one opportunity that is available to the banking industry today. There is a crying need for credit support from the MSME segment. The second is the Government of India's ECLGS scheme, which was initially opened for MSMEs and small businesses. Now it is extended to the 26 stressed sectors identified by the Kamath committee, and 20% of the outstanding as on 29th of February 2020 could be granted need-based by the banks, and they are guaranteed by the Government of India, and therefore there is no credit risk as well. We must not hesitate. Forget the ILFS episode. Banks must not hesitate to fund at least well-run NBFCs who have a good track record. And banks should operationalize the co-lending scheme, which is very recently introduced by the Reserve Bank of India. We must collaborate with the NBFCs because they have certain distinct advantages. They have better reach and penetration. They have last mile connectivity, and they also have a very robust, technology to drive credit, sanctions, credit administration, as well as, recovery. And banks can also grow their credit portfolio by buying out pools from, good NBFCs who have good track record, of course, as per the policy laid down by Reserve Bank of India and the individual banks, board approved, policies. We must not hesitate to use in a big way platforms like PSB loans, which sources large number of MSME proposals, both from the market as well as from other peers. One area which I should point out is that crop loans all banks give. Investment credit is not coming forth. As a result, capital formation in the agriculture sector is not happening. Investment credit is something which the banks, depending upon the needs, must encourage. Agro industries is another area where value addition can happen to agro produce, which can fetch not only domestic as well as export markets as well. There is a 1 lakh crore fund, infragate, infrastructure related, fund. We must make use of that, in funding building up of agri infrastructure like warehouse, godowns, cold chains, so on and so forth. In IBC also, there is an opportunity for the banks to lend to the new owners. Whoever is, taking over the entities which have gone for resolution under the IBC to the NCLT, there are lending opportunities, at least to the new management, to the new owners. There are large number of stalled, projects, whether it is industrial or infra in the country. All viable projects, we must have a relook and explore possibilities of, helping them revive. And in the process, if there is an additional requirement, I think based on viability, based on our own, internal norms, banks, can make use of these opportunities. Government of India under the Atmanirbhar program has opened up defense, space and mining, to name a few, to the private sector, enterprise. Now this will throw up, if not immediately, in the next, 6-12 months kind of time frame, opportunities to lend. The production linked, incentive scheme, which is now extended to 10 champion sectors, along with the existing three, will attract additional investments, and when additional new projects or expansion happen, they in their wake bring new lending opportunities. ROTEP is another scheme which is applicable to the international trade exports in particular, will open up vistas of lending opportunities. In addition to all these things, COVID itself has opened up a vista of opportunities. The pandemic itself has given a lot of new business opportunities for bankers to look at from the credit dispensation point of view. Online education, online tutoring, online uh, education initiatives will offer some opportunities to lend. Health and wellness, unsecured loans under the financial services. There is huge amount of demand today coming up, which the fintech companies are taking away this entire opportunity. They are small value loans, unsecured but high yielding. Banks should look at these things. E-commerce and delivery based services, pharma, life sciences, pathology laboratories, etc., etc. Doorstep services, in these categories, have given lot of opportunities. Managed office space is another area where banks can look at. Last but not the least, there are small scale units which manufacture masks, gloves, PPE kits, sanitary sanitation solutions, soap, tissue papers, touchless dispensers, etc., etc. Is coming up in a big way. I know in areas where I used to work earlier, a lot of people phone and tell me, sir, I have diverted to this new line of business. Opportunities are there. It is for banks to look at them. So therefore, in this not so positive kind of atmosphere today, even there are immense opportunities for the banks, which banks, if they want to encash, certainly there are opportunities to lend. And this is the view I hold, Mohan.
Great. You have extensively covered the opportunities, and I'm very sure the present bankers are all stating that while they are eager to lend, they are looking for the opportunities, and the credit demand should get created. And I very strongly feel that credit demand gets created when there is a proper environment of trust and confidence. Having said,
with all these, 8 to 10% of growth by March 2021 is achievable. It is doable.
good.
We are currently at around 6%.
So when you referred about the stalled projects, it was really in my mind that despite the fact that country was deficient in infrastructure, still deficient in infrastructure, country has to enhance the capacities in various manufacturing sector, and accordingly the lending had happened. Despite that, the asset quality started emerging as a challenge from 2012-13, as bad as 12%, again recovered back to 8%, and now all reports are again talking about the hike. So, Kamath, I would really like to briefly ask you to tell that some reasons for the things going bad, and what are those measures we should take that the history doesn't get repeated.
Mohan, you have raised a very pertinent question with regard to the credit quality. The NPA issue is a major menace, major problem in the Indian banking industry. The gross NPA, which was at 2.3% in March 2008, as you rightly mentioned, rose to 14.58% in March 2018. Thereafter, it moderated to 8.5% as of March 2020. And the Q1 figures slightly better at 8.4%. Non-performing assets, we are all aware, it blocks capital. It leads to loss of revenue, reduces the bank's ability to lend, erodes, bank's capital base on account of provisions to be made. It affects the bank's, valuation itself, and above all, it's a huge reputation risk for, banks. Mohan, if we actually add the SMA and the standard restructured accounts, the problem is still, bigger. The total stressed assets of the banking industry will come to around, 15%. You asked what are the major reasons for NPA? Some are internal, some are external. To name a few, one is adverse selection of the, borrower. We often, end up lending to over-leveraged corporates, poor credit appraisal standards, at least in some pockets, if not, generally. The most important thing, according to me, is the ineffective post-disbursement monitoring. We have lent in, geometrical proportions during the boom period, without, lot of application of mind as to whom we are lending to. Are we lending to the viable projects? There are, to an extent, evergreening of, NPAs during the subsequent economic, slowdown, which eventually led to AQR from the RBI's, side. Internal and external diversion of funds, siphoning of, funds, high-value frauds, not, taking timely remedial measures based on the early warning signals, and delay in initiating recovery processes. This, added and aggravated the, NPA problems. What are the methods of lending methods of recovery currently available to the bankers? One, of course, is persuasive measures. Talk to people, persuade them to, repay, enter into one-time settlements. You have judicial, quasi-judicial, measures like the Lok Adalat up to 10 lakhs. We can move Lok Adalats. DRT, we can move above, 10 lakhs. SARFAESI Act 2002 gives you, lot of powers which you can exercise without actually, at least in theory, without the intervention of the, courts. We have the insolvency and bankruptcy, code, the NCLT, asset reconstruction companies, and lastly, various restructuring programs, June 2019, and the current, OTR, one-time restructuring, schemes of, RBI. Mohan, despite all these, recovery of NPA is painfully slow. Let me place, some data before the, participants. As of March 2019, 31st March 2019, recovery percentage through the Lok Adalat was a measly 5.3%. Through the DRT was 3.5%. SARFAESI was 14.5%. And IBC, as on that date, was 42.5%, thanks to 2 or 3 large value, resolutions that happened, where the haircut was fortunately not, very high. Going forward, haircut being high, recovery through IBC percentage will also come down. Now, having said all these things, based on my personal experience, I have a few suggestions to make, at least to those people, who are listening to this webinar. 3 suggestions on, Lok Adalat, front. The notices issued under the Lok Adalat, process should have the same legal, effect as if it is a summons issued by the court, so that there is some salutary effect on the recipients of these notices and they will respond. My understanding, based on my experience, is that any compromise out of free will, without duress, without coercion, without undue influence, which is reached under the Lok Adalat aegis, is not appealable. Despite this, left, right, center appeals are made and they are admitted. Now, the law must find its feet. Appeals cannot be there when they are not, appealable. This is the second thing, second suggestion that I have. The third is that Lok Adalat is an extremely effective mechanism for recovery, but unfortunately, it is, not having its presence in various parts of the country, and therefore we should establish large number of, mobile Lok Adalats across the country, so that Lok Adalats can become an effective tool, at least for recovering small value loans. So these are three of my suggestions based on experience. Secondly, coming to the DRT, Mohan, my understanding of the DRT is it's a summary proceedings.
Yeah.
At least it is supposed to be a summary proceedings. But what is actually happening is that all processes gone through by the civil courts are gone through in the DRT also. As a result, the original objective that DRT would be in a position to hand down judgments, decrees, recovery certificates within 6 months is not happening. It is only on paper. Cases are languishing, getting elongated, and recovery is getting delayed. So therefore, at least in those cases, Mohan, where borrowing is not disputed, security documentation execution is not disputed, where the securities created are not disputed, DRTs should be able to give summary decisions. This is something which must happen if the DRTs have to become an effective tool for the banks to recover. Now we have established the information utility, NESL, where the banks are uploading the entire information of all loan accounts. Periodically it is being updated. My understanding is that every half yearly updation happens. Entire details of the outstanding securities etc. is in NESL. Can we not link DRTs with NESL so that the existence of a debt cannot be questioned and the summary proceedings can happen as it was originally proposed? This is my second suggestion. Third suggestion on this front is that, rightly or wrongly, DRTs are under the Ministry of Finance. It is a judicial setup. So therefore, logically, at least according to me, this is my personal view, it has to come under the Ministry of Law, and it must be reporting line must be to the high courts of the respective states. Today, large number of DRTs do not have presiding officers. Large number of DRTs recovery officers are not there. They are a very poorly, infrastructure facility is provided, not properly, staffed, at least in pockets. I'm not generalizing. Now, banks cannot knock at the doors of, all the way to the Ministry of, Finance, DFS, pleading, with them for provision of all these things. So logically, according to me, it should come under the Ministry of Law. The governance must be under the, the aegis of the High Court or the district courts, as the, legal brains would, decide. The fourth suggestion that I have on the DRT front is that law says if it goes in appeal, then an X amount has to be, deposited upfront. If my memory serves me right, it is 50%. Now, this is flouted, this is followed in breach than in compliance. Many a times 5%, sometimes 10%, sometimes 15%. There is no basis, no logic, for the upfront payment to be made to prefer an appeal. If a law is there, it has to be followed. Now this is something which I think the authorities that be, the powers that be, should have a relook. The third mechanism for the bankers is the SARFAESI Act. The original intention was that this is giving a dispensation, a facility to the bankers to recover without the intervention of the court, to sell the secured assets without the intervention of the court. Now look at SARFAESI. Under section 14, the banks have to knock at the doors of the CMM for permission to take physical possession. And the authorities are supposed to give approval within 30 days. It never happens. They are asking for details of the borrowings, the securities given. Why can't we look at NESL data, establish that there is a debt, and move forward by approving, by granting permission to the banks for physical possession. Police protection to take physical possession is another big issue in the field. It takes its own sweet time, because they do not, for them, giving police protection to the bank is not a matter of priority at all. Now these are issues which which must be looked at, so that section 14 provisions become implementable with least delay. There are pronouncements from the highest court in the country that SARFAESI decisions, the high courts cannot interfere. But appeals are admitted under the residual powers. They say we have powers to admit. The whole process comes to a grinding halt. Now these are issues which I thought I must flag. The last issue that I will mention about SARFAESI is that the debtor can move the court once the symbolic possession or the physical possession is taken. They can go in appeal. That is the stage at which an appeal can be made. But unfortunately, there is no time stipulation within which the order is to be passed. Now, this is something which the authorities should look at. Now, coming to IBC, last, of course, because of pandemic, now reference is deferred for 12 months period. But now the decisions given by NCLT authorities, enforcement authorities, question. The IBC law says that the orders passed by them cannot be challenged because they have an overriding powers over all other laws. But in practice, what happens is under the AML Act also it appears there is a similar proviso. Which will prevail, bankers do not know. And 2 or 3 cases, large value cases, are held up, on these lines. Last 2 or 3 points on IBC is that we must have a separate dispensation for MSME. MSMEs cannot be put in the same bracket as, large corporates. They need a very, liberalized, kind of, NCLT proceedings, and it must come to the table sooner than, later. Like we have in USA and UK, we must have a prepackaged, resolution plan, which will get discussed between the debtor, lender, and the new investor. All parameters will get decided upfront, and then only the NCLT will be moved, so that NCLT has to only approve the resolution plan, so that things will not get delayed. Things will proceed with the speed it requires. Now, like DRT, NCLT benches also must be increased. These are, some of the suggestions which I have on the
Good.
laws governing, recovery. Sorry, I have taken little more longer time
No, no
because
issues.
I thought, these suggestions should reach the ears of,
I will,
people
I will
who
like
can
to,
make a
I will
people
like,
who can make a difference.
I will like to add only two things. One is that uh, uh, the crux lies in the execution, and thus probably all the laws needs a real uh, execution, follow-up, and accountability. That's very, very important. And second part is that all these things should really bring out a little cultural change among the borrowing community. Because unless you are able to bring a cultural change in the borrowing community, any amount of laws, you will see that people have got ways and means to really the flout. So
To
one
circumvent.
thing which I'd like to add, Kamath, on your information about a wonderful suggestion on NESL and DRT. Charan Singh ji, for the information of all audience, I'll tell you that NESL has already embarked on the digital documentation execution through the API-based product, where every document which will get executed will automatically get into the information utility as a repository on an ongoing basis. There is a repository of the mortgages available with the SARSAI, and thus the law authority should not really demand for all these papers and waste time, and all this information can be pulled from all these repositories to really smoothen the process of the recovery. But I feel the cultural change is the one thing which has to be attempted by everybody in the so uh, I would like to, Charan Singh ji, add to what Mr. Kamath said, is that what is going to really make a change and is changing is a proactive credit monitoring. And I think that's the crux of the whole game, and which Kamath said in the beginning, that our adverse selection of customer, lending to over leveraged corporates, maybe the post disbursement monitoring. And there I would like to bring out to the benefit of the participant that the industry has evolved and has definitely shown a substantial improvement in the methodologies of the credit monitoring, which all started, let me tell you, there was a time when the credit monitoring and credit sanction were part of the same vertical. It all started getting separated, that no, it has got to be two different functions and all that. In 2015, yeah, if I would like to say that we all embarked on the program called Indradhanush. That is the seven were identified, and the entire public sector banks, they sat together and they discussed on the various initiative of Indradhanush, wherein the distressing of the public sector bank was one of the major thing. Now, in that, there is one another point which I would like to bring to the notice, where Kamath referred to the stalled projects. Let me tell you, the project management group has been created at the level of cabinet secretary. The whole idea was that if the project lending has happened, the project should be made productive in the given timelines, so that there is no cost overrun or a time overrun. I'm sorry to say that it has, again, the execution has been lacking. There was no reason for so many stalls project to be there and finding a fault only with the bankers in lending. All projects which are conceived are duly licensed. There are validations of the various assumptions on which today also the infrastructure projects are getting rolled out. Today also the assumptions are of the monetization of the infrastructure projects which will happen going forward. But why not we address the issue of the present projects which are stalled and which are not performing or productive? And if that happens, that's very, very essential. Another part which I am very, very eager to say, that yes, it is true that in those days banks were looking for a size. So the consortium were of 20 bankers, 25 bankers. And today, through these efforts of Indradhanush, and I'll also like to bring the efforts of ease. Another program which is being driven by the banking industry and public sector is called the Enhanced Access and Service Excellence, called EASE. This is a third version of the EASE which is in action now, where we are all talking about that how exactly the proper credit monitoring can be done by using the various uh, databases within the bank and outside the domain. Structured information, unstructured information. Today it's all possible that you have got so many databases available which can be really pulled. Let me tell you, today bankers are doing that. Every proposal or even on an ongoing basis for a monitoring, we are looking at whether it's paying GST correctly, whether there is a IT payment happening in time, whether there is a EPFO compliance happening, whether litigations are there, and so on and so forth. So I think the bankers are gradually moving to the enhanced way of credit monitoring. And I very strongly feel that the smaller consortium, very stringent what do you call the norms for the multiple banking, the intercreditor discipline, and these are things which the corporates have misused. I mean, if you really look at the problem of the NPAs, it is all because of the diversion of fund. Despite there no, I mean there have been the lack of equity, as he said, the financing to the leveraged entity. What has happened? The borrowing has been converted into equity, and on that equity again the leverage has happened. And if that is the case, I think we all have to be very cognizant of the what are the operations in the account. And there my suggestion is, which we had thought of while I was at the IBA. I will like if that can, there has to be a real time or near real time monitoring of the current account or cash credit accounts in the consortium. At the end of the day, all the transactions should get assimilated, which is possible today in the blockchain technology, the distributed ledger technology, what you call it. At the end of the day, the credit debits of the various accounts should get matched so that you are able to really trace the where the money is going. See, where the diversions happen, it's all because layering of transactions happened. We have not been able to understand, and we could not really monitor the transactions happening in the individual account. The consortium have been only sharing the outstanding at the end of the month. That's all. And every bank was comfortable ensuring that his account is in order. Today, I think all the bankers have learned lesson. Very stringent intercreditor agreements are getting signed up. People are cautious that nobody should be able to have been allowed to take a ride for the bankers. And I think if these things are happening, probably I'm very sure that things will go right when we are doing a credit monitoring at the enhanced level, right from the selection of the borrower, release of the facility, and follow up of the facility. And it is not enough that whatever I disbursed, it is enough. There has to be an ongoing. And now today there are n number of ways where through the early warning signals are getting generated. You all must be aware that the bankers are all working on trying to create the flags for the early warning signals, as many flags as possible generated through a system, so that you are able to proactively really improvise the credit monitoring and take the things forward. I think I will stop here, Kamath, and we'll hand it over to you. If you can throw some light. I think before that, I'll also like to slightly cover on what has happened to the various frauds, because we are short of time, so I would like to cover it. See, the frauds analysis have been very nicely done by the CBC, and the top 100 frauds in various sectors have been nicely analyzed. There are causative analysis, there is sectoral analysis, and from all this fraud analysis, we have come to the I mean, observation that there is a laxity in due diligence, there is a misrepresentation of facts, there is a over and under invoicing, diversion of funds, clearing of transactions. And here I would like to bring one point for the consideration, Charan Singh ji, which you can play. it is not the bank who is the only gatekeeper of a fraudulent activity or a financial crimes. The gatekeepers of the financial crimes in the financial system is everybody who's responsible to, whether it is an auditor, whether it is a chartered accountant, whether it is various authorities who are certifying that things are in order. And thus the gatekeepers, and it is being talked at the global level that the gatekeepers of the financial systems have to strengthen and make sure, because bank is one part of the whole story and not everything. I think here I will stop and would like to take Kamath, because we are hardly having now 10 minutes to go. Kamath, ever since the Basel norms have come, I am proud and happy that Reserve Bank has been proactively prescribing the norms which are stringent in the global norms. And it was essentially to see that we are the new players, the technology is not in place, the system identified NPAs were not there, and we were envisaging that there could be some problem. And thus, the various norms were definitely stringent as compared to the global norms, including the provision coverage ratios, which are stipulated way back in 2010 for 70%. Now the provision coverage ratio is very respectable, above 65%. And the problems of capitalization, capital is very much there, because that is a necessity for the credit growth. Would you like to throw some light on the how exactly the Reserve Bank should look at the Basel norms in today's situation, so that the bankers get some kind of comfort on the capital requirements?
Thanks, Mohan. I would state what I would, feel is the right thing to do. I cannot be holding brief for anybody else. But as a practicing banker till some time back, all that I can say is, Basel III mandates, higher capital adequacy ratio. With the economic slowdown earlier, huge NPA burden, and now the pandemic impact playing out. Indian banks, the question all of us should ask is: are we well placed to comply and conform with the Basel III norms, in particular the capital adequacy ratio? You yourself mentioned, Mr. Mohan, that when the Basel norms were first introduced, the capital adequacy ratio was stipulated at 8% by the BIS, but Reserve Bank of India in its wisdom thought we should be slightly better than the international standards, and therefore kept it 9%, and rightly so. The whole objective was, at that point in time, the banks must have the ability to build the ability to absorb financial and economic instability related losses, to improve the risk management and governance in the banks, and to improve transparency and disclosure standards, and last but not the least, to protect the interest of all stakeholders. Under the Basel III, as we are all aware, we are supposed to reach a capital adequacy ratio of 11.5%. The capital conservation buffer, the last batch of 0.625, is deferred by RBI. Banks have been given some time, but sometime in the near future you have to reach that level. And to that, if you add counter-cyclical buffer and the extra cushion that is required in the ICAP, etc., banks will have to, willy-nilly reach a level of, about 16% or thereabout. As on 31st of March, 2020, if the data I have is correct, the industry, capital adequacy ratio is of the order of 14.8%, which has in fact come down from the September 19, level. Now, if regulatory capital is so high, will the banks be left with, much capital for growth? What we, refer to as the growth capital. Now, this is the, moot point. In the committee of, bankers, some banks will be very well placed, 18-20%, capital adequacy. Some will have 14-15%. A few may not be even meeting with the, the current mandated levels of 11.5%. And as a result of which, particularly in the context of, public sector banks, Government of India has been, infusing capital from time to time. If we look at the historical numbers, between 2008 and 2019, Government of India, has provided 3.16 lakh crores of, capital, which is a colossal amount. 2020 recapitalization bonds are also, issued to the extent of, 65,000 crores. This has got a huge fiscal cost. Given the impact of pandemic which is playing out today, the adverse impact on the revenues of the Government of India and the state governments, in general, can the Government of India, or is the Government of India is in a position to continue to, provide, capital infusion to the public sector banks is the issue. Now, therefore, in my personal view, the way left for the public sector banks is to access the capital market as well. Now, given the current level of, the NPAs that are prevailing in the, banking system, public sector banks in particular, the large value frauds to which you referred to, the adverse impact of the pandemic on the bank's balance sheet. Today, for a host of reasons, you do not know the actual, level of NPAs in the banks. Once the Supreme Court comes out with its final decision, once the impact of the pandemic plays out, once the restructuring, etc., is over, then only you will know the actual picture as far as the credit quality is concerned. So today there is some amount of lack of clarity.
But I would like
and therefore, Mohan, what I am going to say is my personal view. It is not to be taken, otherwise. In my personal view, our bank's ability at this juncture to conform to Basel III capital adequacy related, norms, in my way is found to be, in my view, is found to be wanting. Therefore, the question and the suggestion that I would like to make is it possible for us as a nation to defer implementation of the capital adequacy norms under Basel, 3, let us say for a period of 2 to 3 years, say till end of FY24, so that the banks can recoup. They know what would be the impact of all this slowdown and the pandemic, etc., etc. They will be able to, over time, build capital and provide for bad loans, etc., etc., and then reach a ability level, capacity level to conform to the Basel III norms. I do not know whether it is right and proper for me to make this suggestion, but this is the view I hold.
I would just to supplement when you were talking about the large value frauds. Let me tell you, going by the definition of the fraud, if you are able to see that there is a diversion of fund in the account, it is classified as a fraud. And in 2020, the fraud amount declared was 1,86,500 crores in almost 8,500 accounts. It definitely does not mean that the entire money has been moved out of the system. But what happens if there is a 100 crore project where if the diversion has happened for 5 crores, even then 100 crores gets branded as a fraud and you need to provide for 100 crores. And I think towards this, even the bankers had probably moved to the regulator that whether the provisioning instead of 100% can be related to the unsecured portion in the fraudulent amount or the so-called the fraud which has happened in that account. I think that may also to some extent may release the capital. Before I close, I would like to only ask one more question, Kamath, because I know we are running out of time. And quite often the public sector banks are seen getting challenged on the governance and compliance. So I would like to be extremely brief and uh, give your views. I'm very personally convinced that it's not that the public sector banks didn't know what is the governance and compliance. Yes, probably we needed some more support to be more governed and more compliant. So over to you.
I will try to be as brief as possible, Mohan, because this is a very, ticklish kind of a question that you have, asked me. That said, Mohan, as we are all aware, clause number 49 of the listing agreement and the PJ Nayak committee report are the two doctrines based on which the corporate governance and compliance issues in the public sector banks in particular play out. While most of the recommendations have since been implemented, some are still work in progress. Now, the composition of the board and the quality of the board is an issue, in my humble opinion, even today. The board should consist not only of retired bankers, at least one or two. There should also be subject matter experts like IT, HR, risk management, etc. in every bank's board, so that these critical issues get proper focus, attention, and wherever needed, corrective course correction could be made. This is one issue that I would like to flag. The second issue that I would like to flag, and Mohan, whatever I'm saying is, I are my personal views, not to be taken,
No, I think I too share
otherwise.
same views.
I feel for protection of minority shareholders' interest, lot of things need to be, done. And therefore, is it possible to have a director on the board who can represent the, minority shareholders? And most of the banks today are listed, and a large portion of the, capital is widely held by, retail investors who are, very small, and their interest needs to be, protected. This is the second issue that I would like to, flag. The third issue that is that the appointment of independent, directors, whether it is on the board of public sector bank or on the private sector bank, there should be mechanisms to, actually confirm and validate the, fit and proper, criteria. Now, this is the third issue that I would like to, flag. How it has to be done, it is anybody's guess, but the minds who are responsible, should put their heads together and, find a way out. The fourth issue that I have in mind is the separation of ownership and, management, which is still a far cry. You will recall that the PJ Nayak committee did mention dual regulation of public sector banks, must end. And therefore, a bank investment, company was supposed to be floated, BIC. The equity holding of the government of India was supposed to be transferred, so on and so forth. I'm sure it is engaging the attention of people. Coming to private sector banks, I would go one step ahead and say there should be strict provisions in the code of conduct for the management, to ensure that nobody acts at the behest of the owner. And if something, is acted upon, then there must be, penal provisions to, deal with, or some disincentives, should be in place. The next suggestion that I have is independence of true independence. It is not on paper alone. Independence of the chief risk officer, chief compliance officer, and head of audit and inspection in banks. They should be made to laterally report to the board. The chief risk officer should report to the risk management committee of the board. The chief compliance officer and the head of audit must report to the audit committee of the board. In the truest sense, he reports only for administrative purposes to the head of the organization, who is the MD or the CEO. And there has got to be a window periodically available to these three key persons, to discuss directly, exclusively with the RMCB or with the ACB, and share their views and thoughts, particularly whatever negative things, if at all, they see. Now, this is something which must work, effectively.
Fine. I think we will try to hand over now.
And the position of directors, etc., including the MD and CEO, should not remain unfilled, beyond a time. In fact, I would suggest there should be a panel from which the as and when the vacancy arises, people could be identified and appointed, so that we ensure continuity. Mohan, these are some of the thoughts that I have on corporate governance.
So,
and if there is a good governance, if there is a good governance, automatically the compliance also will be very robust.
Yeah, it happens. So, Charan Singh ji, before I close and head it over to you, I'd like to bring 2-3 points for the benefit of the viewers. I'll take you back to the 2009-10 situation when we as the executive director used to go for the investors meet. The investors used to only ask one question: Mr. Tansale, is there any way that the FII limit can be increased from 20% to 40%? And I know as the EDPNB, my FII was 19.99%. All efficient numbers were on the top of the roof. If we had probably divested then, and we had really allowed the banks to go more, get into the board positioning and all. And let me tell you, every CMD in his own way tried to bring the specialist to the window of the shareholder director. But it has not served all that purpose. And all guidance and everything comes post. I think these are, I'm very happy when you said about the pipeline under the BBB. Last year, 75 jal measures have been identified for the leadership pipeline. They have been subjected to 1-year program in the IIM Bangalore. Charan Singh ji knows very well about it. And the pipeline of the leadership is getting created. And hopefully we can see the good days, what we have seen in 2009, 10, 11. I think with this, Charan Singh ji would like to hand it over to you. We tried to share our hands-on experience as a banker of 4 decades. Thank you very much, viewers.
I really want to thank both of you for such an excellent today. It's been a treat. I think all of us who are listening were glued to the screen listening to both of you. We have had, fortunately, some bankers. Hence, Mr. Kannan is here, Arvind Mohan is here, and Ajay Pai is there. They have lots of questions for you. So if you agree, both of you,
Sure.
Can I request 3 of them to ask their questions? I'll go in the sequence. First, I'll request Mr. Kannan to ask his, and probably he's also an experienced banker, share his views. And then I will go to Mr. Arvind Mohan, and he also edits a beautiful monthly, which will add to the value and the thoughts that have been discussed today, probably he'll be able to carry it. The recording, I'll be more than happy to give it to Mr. Arvind Mohan, the links, if he wants to share with the audience. And then after that, we will go to Mr. Ajay Pai. So, Kananji, can I request you to please share your thoughts and questions?
Thank you, Dr. Charan Singh, and good evening, Mr. Sangsali and Mr. Kamath.
And then
Nice
open your video, yaar. Let me see you.
Let me see once again.
Kannan has been my successor in the IBA, so
It's a banking family today.
yeah.
While he's opening the window, I would say that these sort of interactions that one we had today, so necessary, such vast experience that people have, and they can be providing inputs for the current generation of policymakers. So I think it was very good. Kananji, are you ready? Can we go ahead?
Yeah. I think there's some problem with my video, Mr. Sangsali. If you don't mind, I'll continue with this.
I can see you with your voice. Don't worry.
Okay, so thank you. No, I think it was a very exhaustive topic. Covers the entire gamut of issues facing the banks. And as Mr. Kamath rightly mentioned, it's not only the bankers to be blamed, but unfortunately, we become the scapegoats, and easy what I call the whipping boy, and we get whipped. Anything goes.
Kannan, we lost you.
Sorry, anything goes wrong, it is the bankers, and anything goes right, it is someone else. And we never get the credit. In fact, when I visited the branches here, and I find that almost the entire staff is there in the public sector banks, my heart bleeds, and I really feel bad that these people come almost every day. They have been coming to the branches, and hats off to them. I think they are, and many of them have lost their lives. And may their soul rest in peace. Now, coming to the particular topic, that's one particular issue which always worries us. One thing is the raising of the capital. While Mr. Kamath says, the easiest thing is to get the Basel postponed, but you will also understand that whenever we look at any corporates, we look at whether they've got adequate capital. That's because the corporate has got, say, a gearing of less than 2 or something like that. And the more the capital, we are also comfortable. I'm sure the world at large, and including India, people will be very happy to see a higher amount of capital. And I think reducing the capital may not necessarily be the solution. The only solution is to be raise the capital. And Mr. Kamath rightly mentioned that we have been, the bankers have gone with a begging bowl to the government time and again for the last 6 to 7 years, and more than 3.5 to almost 400,000 crores have been raised by the government, and with the precarious fiscal situations. So what steps have to be taken to make the banks viable? You can't simply say, no, we want this, we want that, but we need to find out is there any possibility of the banks actually become viable, in the sense, become profitable on a continuous basis? Because leave alone the additional funding we have done, we have not given the necessary returns to the government. Of course, some people will say, no, we have paid taxes. But I think we need to, as the private sector banks, except a couple of them, most of the bigger private sector banks have done a good job in making profits, as also attracting foreign capital and domestic capital. The public sector banks are wanting. What steps to be taken by the banks or in the ecosystem to ensure that the banks actually are viable, in the sense they are in a position to attract capital?
Yeah, Kamath, please. You are muted. Please unmute.
Kannan sir, the one way to do is to maximize your revenue, minimize your cost, and the third is to conserve capital. Now, what is happening in public sector, all of us know, we don't price our assets appropriately. in the name of competition, we try to undercut the other and try and book the assets. Now, this is one reason, according to me, which is hitting us very badly on our revenue side, income, interest income, in particular. We underprice and undersell most of our products, including financial and non-financial kind of products. Yes, there are some restrictions here and there from the regulator side on pricing as well. If we follow the RAROC model and price our credit assets appropriately within the given interest rate framework, then we should be able to increase our interest revenues. If you do that, your profits will be better, your retained profits will be higher, and if retained profits are higher, your capital also will get shored up. I have done the same thing when in the being in the bank, when you are responsible to meet targets, we all undercut on our pricing. This is one thing. The second thing is is to cut costs wherever possible. There are umpteen number of ways and means how can you cut cost. Now we should ask a question ourselves: do we need these many number of branches? Today I had gone to one particular place. Of course, this is too early. Post merger, in the same street, I find 3 branches, of the same bank. Now, this is true post merger. Even before merger, also, in Bombay, I know a particular place within a radius of 1.5 kilometers. Mohan used to be, heading that zone. We have 5 branches. Do we need, branch means sunk cost. That many more, staff. Now, this flab has to be cut. If the flab gets cut appropriately, ideally, optimally, various costs in various ways can be, reduced. Then, of course, we have to conserve our capital. There are ways and means. In the interest of time, I cannot get into, the details. Even without raising capital, fresh, existing capital can be conserved, so that your capital requirements, net incremental capital requirements can be, reduced. One way is to grow your, book through capital light assets. This is one way of looking at it. Institutional guarantees are, others. There are various ways, means by which, you can conserve capital. Even, 5-10 basis points, get saved. To that extent, your requirement of capital will, come down. Now, deferring the Basel III was only an out-of-box, suggestion that I made. I am not saying that this is the solution for the current, problems. This is one option that can be looked at. Now, you mentioned about corporates not being adequately capitalized. Partly, we are ourselves to blame. Partly, there was a time period between 2004 and 2008-9. We not being very mindful of the quality of the borrower's balance sheet. Over leveraged, balance sheets. We have gone on, funding. They were borrowing from bank X. Those days we used to have what is called as a corporate, term loan, corporate, loan, general purpose corporate loan, as it used to be called those days. That used to be shown as, capital in an SPV, which undertakes, another project. Now, this is, borrowing, from one source and investing in another source, as an equity. Now, these kinds of things have happened, in the past. We should, going forward, be more mindful of the quality of the borrower's, balance sheet. Of course, today a lot of steps are taken by the regulators, by the banks themselves, etc., and hopefully the quality of lending would be better, as we move forward. Experience has made us more prudent, bankers
I,
more prudent.
I will
That is
just
what I
like
will say.
I would like to supplement Kamath. Consolidation has given us a right opportunity for rationalization of cost, and I think it should be very seriously attempted to. Does not mean that the employees are out. It only means that you release the employees for a better cause. Even today, if you look at the other income part of the private sector banks and the public sector banks, very different. No doubt we have improved it substantially, but then you can deploy your people. It means I would like to bring the focus to the productivity. And when you talk about productivity, productivity should be in terms of not only the deposit and advances, but the productivity in terms of a 360-degree view, the complete gamut of the financial products which the banks can give to their customers. I think the financial inclusion, the PMJDY, all those have come very handy. If you can really leverage on them. So rationalization of cost is possible today with the given consolidation. Now the four banks which are left out in the public sector, I think they should really prepare themselves for in a position to go to the markets for getting the investors. And that is how probably the burden on capital can go and the banks can get further capitalized. And the last which I would like to add, Kannan, you will agree that there is a great need for capacity building, and in the East 3 there is a reference to it that the HR centric or productivity centric HR activities should be initiated. I think what has happened, if all of us who are senior in the banking will realize in the last 10 years, there was huge retirement and the youngsters have got the promotions very quick. So that kind of a seasoning which was required, that can be bridged only through proper training and capacity building initiatives. So these are the ways probably the productivity, profitability can be increased and you can address the capital issue.
Mr. Arvind Mohan waiting to ask a question, and then we'll go to Mr. Ajay Pai, and then we will go to Professor Ram. So I'm going to requesting Mr. Arvind Mohan, please go ahead.
Good evening, sir.
Good evening. Good
Actually,
evening.
there was no question as such. I had some observations only regarding, for example, Thangsale sab was talking about infra financing and the affiliate projects and all. So my observation was that infrastructure financing is risky, fine, but at the same time, infra development is also very risky. So most of the projects which are stalled today are stalled not because of any fault of the promoter or a fault of the banker. What has happened is some unforeseen event came later on, for example, some agitation or something which stalled the project. And in a way, it blocked the funds of the bank. So we should take up actually in some way with the government that infra development itself should be made risk-free, which in turn will make infra financing also risk-free.
You're right. I agree.
So that was my one observation. Second,
in some other forum, Arvind Mohan, I have mentioned that it is high time that a specialized development financial institution is established in the country.
Yes.
This is the crying need of the time. Banks do not have the long-term resources to fund. I was only mentioning stalled projects where banks themselves have funded and where the money is stuck.
Yes.
Let me give that clarity to your question. The need is the infrastructure DFI must come. We had earlier one IDFC, it has now become a universal bank. We still have an IFCL which is doing what it can do, but the requirement of infrastructure funding is colossal. If you look at the national infrastructure pipeline, NIP, the requirement is 111 lakh crores over a period of next 3-4 years. So where from the money will come? Now, banks do not have the wherewithals to lend. nor do we have the expertise to, do a credit appraisal.
Right.
In all banks, in all setup, we should encourage the, project sponsors to access the capital market, the bond market in a big way, so that overall percentage of the bank lending component in the project funding actually, comes down. And, bond funds or the FDIs or the, overseas, capital, moves in. Now, these are some of the ways and means in which the, infra funding can be done. The idea was not to say that the bank should be active. No, not at all. Wherever we have the comforts, wherever individual, project owner or the projects are viable, where the banks have the comfort level, they can jolly well. Ultimately, it is left to individual banks, credit judgment. Thank you, Arvind.
So second thing was an observation from when I was a branch manager. So I observed there was a cycle on prices. There is a real estate prices, they move in cycle. So at that time also there was a cycle when the prices of real estate were going down. So there was a reluctance on the part of the borrowers to come forward and repay their loans or whatever and get their collateral freed. Same way, when the real estate prices rose, those very borrowers, they came forward, paid the money to the bank and took their assets. So same way what I feel is right now there is a cycle in which real estate prices are going down. The moment it starts picking up, the NPAs will also come down accordingly. That's my feeling. Are your views?
You are absolutely right. Arvind, I'll give you the example in 2002 when the OTS came, that is non-discretionary, non-discriminatory kind of Reserve Bank had come out with those guidelines. The success of that only because of the price rise in the real estate, where
Yes.
people knew that if I don't do it, the property gets sold out. So it is better that I bring the funds and pay back to the bank. So you are right. If the cycle of the property price goes up, that is the right opportunity to create a pressure on the NPA borrowers to come back and repay. And cycle will definitely come. Yeah.
And one more thing I wanted to say was regarding the history of banks when banking, when it was being discussed, we had social control, then came liberalization, and with liberalization, the focus shifted. Now we have to take care of the interest of the investors also in terms of profit. So earlier, social responsibility was the only goal. Now we have a duality of goals which are self-conflicting. So how do we resolve this conflict as public sector banks?
I think that both can go together. Nothing wrong about it. I mean, you can really deliver your social responsibility, ensuring the health of the balance sheet. Now that it's possible, probably in our days, yes, it was not. But with all that, we have delivered the value to the investors. I mean, I remember I have marketed the IPO of Union Bank in 2002. And in 2008-9, everybody who bought because of me thanked me profusely. So, I mean, both ends can be made. You can create the investor's value if you are doing consciously your responsibility.
Banks do not play the, social responsibility to the extent that is entrusted to us by the government. Who else will don that role?
That's right. I agree, sir.
Now, let me make one point. When during my times, I was extremely active in the SHG funding, self-help group,
Yes.
funding. The collection percentage was as high as 97 to 99, depending upon the cycle, the so-called cycle that you mentioned. No, during the downturn also, they were the best, paymasters because of peer pressure. And to conclude that social responsibility based lending may not be in the overall interest of the investor community, may not be a well-founded view. given the circumstances that is prevailing today, look at the gold loan companies, look at the MFIs, their recovery, their collection, percentage, even in difficult times like today, have reached the pre-COVID level much faster. Why? It is not because they have the last mile connectivity alone, but the borrowers are, basically honest. Small borrowers, I hold the personal view, are, their integrity levels are much, higher. Thank you.
Thank you, sir.
I request Ajay Pai if he has any questions. Ajay? I think Ajay might have left. Then we probably, can I request Professor Ram? Professor Ram, would you like to ask a question?
Of course, can I ask the query now?
Yeah, please.
Yeah, of course. It is my honor to be in this meeting because we have here doyens of banking. Because I also, in a sense, come from the banking industry. I was in two different banks and then RBI. And the question or observation I have is, I think, obviously driven by my philosophical stance. Because whenever an issue, banking issues get debated in such meetings, I am of the view we do not talk about the elephant in the room. Okay, and that's something even today, because I got the invite today from Dr. Charan Singh. The title was Contemporary Issues. Okay, and all of us, very enriching discussion. But I guess nobody asked, okay, for that matter, we never touched upon the issue. Why should we have PSBs? We have the example of Air India. The business of government is not business. This is the stance I have. I'm not saying it is a fact. It's a stance I have. Because if I look at the financial parameters of various groups of banks, I track banking system for certain reasons. On every conceivable parameter, whether it is return on asset, ROE, or NIM, or for that matter, even a simple factor like CASA ratio or NPA, PSBs are at the bottom of the rank. In fact, I teach banking. When I teach banking, when I talk about statistics, I give Indian banking statistics in two ways. Remove the PSB where we stand. I compare the IMF data across countries and add the PSBs where we come down. My query now to this, very esteemed panel is, why should banks be owned by government? Because this is, in my view, a hangover of the command economy model, a socialistic pattern of society model, and Indira Gandhi's other agenda items. I won't get into that. Why do we carry the burden of the past? Because we have, I tell you, even today, in my view, PSBs have franchisee value. And it is the right time to give auction these PSBs to the best of bidders. Think of what happened to XPUS Bank. Remember, it would have gone into, any one of us know, I am from South. It was actually a rod band by any definition. Today we have a buyer, and I hope, in whatever way, DBS will be able to turn around. Why we need to have government in the business of banking? And any one of us who have worked in PSB, I was in two different banks and RBI. That when it comes to performance metrics, we are nowhere near HDFC Bank. We are nowhere near any other, the best private sector banks or Citibank. Why do we have to have PSB? This is a crux of the query I have.
Yeah, yes, Kamat, take it. Unmute.
Mohan, can I respond?
Yeah, I want you to respond. I'll supplement.
Yeah. It's a very, very important, question. But the issue is of timing. Can we change overnight is the issue. There is a history of a few decades, why the decades of experience the requirement at that given point in time, why the banks had to be first brought under social control and then nationalized. I mentioned in answer to the first question, we have come one full circle. Private sector is not the panacea for all the ills that are prevailing today. We have seen what has happened in the private sector as well. Examples may be very few and far between. Therefore, to say that the public sector has to be disbanded, privatized overnight may not be a good thought according to my personal view. Yes, efficiency has to be improved. I fully agree with you that the government has no business to be in business. It is best left to the private players. But today, whether I or you like it or not, there are public sector banks, and they control about 65% to 70% of the assets and liabilities of banking system. You cannot wish away the public sector banks, convert each one of them into private sector, sell them to some private entities, etc., etc. It has to be very carefully calibrated, kind of decision that is to be taken even by the current owners, the Government of India, the Ministry of Finance. Yes, we need to, rather than privatizing, overnight, the first step, as the PJ Nayak committee rightly mentioned, which is a report which is accepted by both the RBI as well as the Government of India. A timeline is fixed for reducing the government holding to less than 50% over time. First step is to convert to pool the government equity holding of all public sector banks into a company where the investment will be parked, and from there it will get reduced to less than 50%. So the governmental controls will get dismantled, and from there onwards it will largely be a privately owned bank. It will take time. Unfortunately, the economy has been going through wild swings, and therefore, depending on which side of economic cycle, trade cycle you are, decisions needs to be taken. And as we speak today, some 3 or 4 public sector banks which have not been merged thus far are earmarked for privatizing. And there is a great amount of opinion making that is happening, that it is not enough if for the government to reduce their holding, they should exit fully, lock, stock, barrel, and hand it over to the private sector. I am sure it is work in progress. There will be application of mind from the ministry also, but I hold a very strong view that it cannot be done overnight. It has to be well thought of, well crafted over a period of time in phases. It needs to be done overnight. Asking the government to exit from public sector banks will bring in more problems than we seek to solve. So this is the view that I hold, and I again reiterate: private sector is not a panacea for everything.
Absolutely. Okay. I mean, private sector, if it is a panacea, how come we got into S bank trouble? Okay. And I mean, I'm not saying privatization is a panacea, but I guess, I mean, I think as an industry, I think there is a hangover. The government should be in the business. My only, limited point is, when the PSBs have franchisee value, we should give it, not when nobody wants to touch them. Say, think of New Bank of India in 1991-92, if I remember right. Would anybody touch the bank? No. We have to force PNB to take it over. We should not move to that platform. That's why, first point. The second point, see, remember, before we privatize, sometimes we have concerns.
Professor Ram, if I may, I'm sorry to interrupt.
Sure. Yeah.
I think the Government of India is fully seized of this. Otherwise, the discussion, even at a very basic rudimentary level, about privatizing the 4 existing public sector banks would not have arisen. According to me, my guess is that they are seized of this matter.
No, I'm not privy to what the government, I mean, Babus are thinking. I can only see
not.
what
I'm
is
also
there on
not.
the ground. No, I'm just,
I'm
I mean,
also not.
as a common man, I react. And for one additional point to the other topic you talked about, which was very, very well talked about by you, the governance structure or, I mean, corporate governance in PSBs. Because I thought, because I have a pretty strong feeling, I have written one article also on that. India is possibly only country where RBI has presence in the board of commercial banks. And again, I guess India is the only country where in the central bank you have the central government having nominees. You can't have more conflict of interest than this. I don't want to go into specific case. In one bank's PSB's case, there was a fraud, and the decision was taken by the board. And in the board, there was an RBI officer. I know him. Then investigation was done by him. It
I
happened.
will.
I'm
So
talking about Yamashul case.
I'd like to bring 2-3 points to Professor Ram's previous question and the present question also. Let me tell you, when you are talking about the various efficiency numbers, I think I did make a mention that the all public sector banks had all these efficiency numbers at par, and that is how I said in 2009-10 the investors were looking at, can you ask your government to increase the foreign institutional investors stake from 20 to 40%, and we were all for it. So not that we are not for it, we were all for it, and that's what we have driven. Coming to your this point, I personally feel that I mean, the banks, uh, if I'm not wrong, the boards, the management committee which approves the credit proposal, now the RBI directors are not of a part of the management committee. That is my view. Probably during my tenure only it has been stopped that the RBI guys will not be part of it. Then CBC said that the CVO will not attend the board meeting. So all these conflicts are probably are getting addressed gradually. That is what is my understanding today. I think Charan Singh ji should be able to.
Yeah, I think he is, I think, much better informed.
Because we are now 8 years old. Chairman, we retired in 2013. But the whole idea was to remove this conflict part, as you rightly observed, Professor Ram, about it.
Thanks. Thank you for taking the queries. Okay.
Yeah.
To take Professor Ram a challenge in January or February. I'm going to request Professor Ram to join us as a panelist, and we will take up this topic of relevance role of public sector banks in India, development,
Certainly.
looking forward. Right?
Certainly, sir. Okay. Thank you. Okay.
We look the role they played in the past and what they can do in the future. And I also hold the view that the public sector banks, they served a great purpose when they came in. But if you ask me the question, and which has been answered by our former governor, Dr. Y.V. Reddy, did the nationalization take place for really financial inclusion and extending banking to the rural area? Or was it mainly for any political reason? Dr. Reddy holds the opinion it was for political reasons.
I,
And
I agree with you. I
he
concur.
beautiful article on it, and that topic we will take up. Now, I would also
Certainly.
like to mention one more thing. I was doing the analysis myself, and I felt this is a paper which I wrote on role of public sector banks when I was a professor at IIM Bangalore 3-4 years back. I am of the view that if the services of the public sector bank are commercially priced and provided for, even if they include social control, even if they are at the behest of the government, you don't need to bail public sector banks. If you really price the services that they provide you, including Jan, the accounts that they open, and the cost that they incur to open each of those accounts, then bailing out would not be necessary. So the point I'm making is that I agree with Mr. Tansale. The public sector bank employees are as efficient as a private sector employee. And therefore, the Yes Bank can get into trouble and other private sector banks can get into trouble, as do the public sector banks get into trouble. My feeling is that a good study needs to be conducted which prices the products and shows that if this is how the pricing was done, this is what the balance sheet and profit and loss account of a commercial bank would look. And I can promise you, it will be as competent as that of a private sector bank. That study I have not seen in the last so many years, though I've been requesting and seeking inputs from various professors as well as policymakers. If we can undertake that study and somebody can fund that study. If you do it, as I mentioned, I'm sure most of the myths related to public sector banks would be busted, that they're inefficient, they're unproductive, that they're lazy, they sit on heaps of money, and that they're misleading the taxpayers. The last point I want to make in this context is I have a feeling that both the public and private sector suffer from one malady, and that malady is tenure of your service. Once you have a tenure of your service, that I will retire at 35, after 35 years of service, then I will get pension, or that I have till my next 35 years, nobody can touch me, that brings in inefficiency.
Yeah, that is the issue.
Once you have contractuals renewable every 3 years to 5 years, automatically you will see the efficiency levels shoot up, be it private sector or be it public sector. So I think the malady lies in the security of tenure of service, not in the private sector or public sector characteristic. But in-depth study needs to be done. I'm also of the view that once that in-depth study is done, many good things we will learn. And why I think that's necessary? Because I think public sector banks are here to stay for a few more decades. Some may get corporatized, but most of them will continue to stay. We like it or not like it, but that is how the inertia operates in public policy and in the political economy situation. So therefore, a good study like this would benefit the public sector banks. Ajay Pai has left a message with me saying that he had to leave early, and therefore, if I can ask the question on his behalf. Actually, that question has been answered, one of it, but let me read the one of his questions related to the merger between the Lakshmi Bilas Bank and DBS Bank. Is this a sign that the banking sector is opening up? Would the privatization of struggling banks bode well for the entire sector and easy up credit disbursement? I think partly we have handled that question, but because that question was pointed, I leave it to both the panelists if they want to share their views, as well as if Mr. Kannan or Professor Ram wants to say something on this, why not? So let me first.
Mohan, you can take it up.
No, I think Mr. Ram has already made a and I've been also watching the Lakshmi Vilas Bank. I think the initiative of handing it over to a bank, whether it is DBS or any other bank, let's not get into that conflict because how DBS came into picture is something which only regulator can say. But it is true that there is no point in allowing the weak entity to continue, and the acquisition of the weak entity should happen. And we are seeing it in our banking industry for decades. Let me tell you, as rightly said by Ram, I was in PNB. The new Bank of India was acquired by PNB. Nanangudi Bank was acquired by PNB. Union Bank acquired a couple of small banks. State Bank would have acquired. So I think the process of unnecessarily carrying a burden of a weak organization which cannot be bailed out. The best bailout is this. Nothing wrong about it. I think the GTB, the private sector bank, GTB was merged with the Oriental Bank of Commerce. So bailing out the banks at the right time probably is the right answer. That is what I would like to subscribe to. You're on mute, sir. You're on mute.
Would like to contribute to this, Professor Ram, Mr. Kannan, or even Mr. Subhash Kumar Pandey, Dr. Subhash Kumar Pandey, anyone who would like to contribute to this question? I would like, unless
you're on mute. Professor Ram, you're on mute. Professor Ram,
I missed part of the query. Can you repeat it, Dr. Charan Singh?
Basically saying that the Lakshmi Vilas Bank and the DBS, and is that the right strategy, and does it open up new doors and vistas in the Indian banking?
See, my understanding is, because I think you have been watching banking for decades, but I'm much younger to you. But whatever I have seen, I was in RBI and you were in RBI, you were my senior there. Whatever I have seen of RBI's rescue acts, I would generally, come to the view, okay? Most of the time, RBI would carry out forced gunpoint marriages, okay? Because they mention about GTB vis-a-vis OBC, or for that matter, New Bank of India with the PNB, Nedungadi Bank with the PNB. Had there been the managements have been given fair choice, they might not have taken over those banks. But in my understanding, to the extent I keep observing, this is possibly the first instance. We are opening up two new vistas now. For the first time, we are talking about RBI asking a bank to take over based on its free consent. That is extremely important. I think DBS is taking over this bank, not at gunpoint, as PNB did in the case of Nedungadi Bank. It is a free consent-based takeover. That is point number one. And the second point, which I see, okay, remember, we are opening up another new vista. I think DBS is the second foreign bank to have come to India using the subsidiary route. We have only one other bank, that is the State Bank of Mauritius. If you remove that, every other foreign bank we have, they have branches. They do not have an independent subsidiary in India. So I think now RBI is giving a kind of an incentive to every foreign bank, because RBI prefers foreign banks to have subsidiary here. That is I think the best way to also manage your banking system. So now it is giving, in my view, an indication. If you form subsidiaries and if you find a right candidate for takeover, I guess I would give the blessing. And remember, that will be much a faster way to grow for any foreign bank compared to the normal organic growth. Imagine, a bank like DBS getting around, I think, 500 branches in one go. When it would happen? So I think this is, in my view, a three-dimensional kind of effect. So RBI for the first time sending signal, from now on, all marriages would be based on consent. Okay, we would not be using gunpoint, marriages anymore. Second one, if you are a weaker bank, you can find a suitor yourself, or I might be bringing in suitors. Who is consenting anyway. Third one is, now we have found a new way to open up the banking space. Foreign banks are no more pariah, so long as they, say, dance to the tune of RBI and form an independent subsidiary. And that is good for us in every sense of the term, because we need an extra dimension in competition. Because again, private sector banks in India, okay, most of them, they behave like PSBs with some difference, okay. But now you bring in foreign banks, and this is going to improve the competition. It's going to be gainful for, the customer and the banking system overall. That is the way I look at it. And one side point, I don't want any wrong understanding of my statement in the beginning. Somewhere you made a statement, PSB employees are more as efficient. In fact, they are more efficient. I come from State Bank of India, 1987 PO batch. And I know where all the SBI POs end up. You take any of the private banks, they'll be there in the senior most position, whether it is Ramesh Shobdi or anybody else. So that means quality of personnel. PSBs have the best of personnel. It is because of the constraints that got introduced, because of ownership, because of functioning style, because of compensation. Think of the compensation. We have two esteemed bank chairmen here. what kind of money they would have made, and what is the money today a VP in HDFC Bank makes. A VP in HDFC Bank would have made more money than a bank CMD in PSB. So I think we have put a lot of constraints, and that had, in my view, I mean, I would have a view. I think it has spoiled the performance of PSBs, and that's only. Otherwise, quality of personnel wise, I mean, the best of personnel are from PSBs, and they move to private banks because, I mean, for whatever reason, the opportunities they see are more there in terms of monetary compensation and so on. And I guess, I mean, I welcome this RBI's latest measure, DBS taking over Lakshmi Vilas Bank. And in my view, there are a few more candidates. I hope, I mean, all things will get done in a matter of next 2 to 3 years' time. Because we need big size banks.
I think this, I totally agree. I also like this merger that took place, and I also agree that this was a merger which is giving a signal to the rest of the foreign banks that this is the, if you come and open yourselves to the regulatory supervisory powers of the Reserve Bank, we are going to provide you the level playing field. And
Absolutely.
advantage of the pent up demand in our country, and given
Absolutely.
the banking penetration is still low and this is going to expand, you can become part of the growth story as much as we allowing you to.
Excellent.
So I think also they did a very good thing. There are fiscal constraints, and here if somebody is bringing in money in a way,
Absolutely. Yeah.
it is taking care of the deficit. So I really welcome this idea of the government. With this, as you know, we have had 2 hours of extensive discussion, and here the professors, practitioners came together. And I tell you, online education on banking, this lecture will go a long way. The link.
So, Karan Singh ji, before we say thanks, I've got one more request to you. Can you have the database collected? How much dividend public sector banks have contributed from the date of listing to till date? Kindly come out with this amount.
So what I've done is,
It will be humongous amount.
if you look up my working paper at IIM Bangalore on role of public sector banks for a certain stipulated window, I have given the amount of dividend that has been contributed.
Oh, I see.
What you have asked is from the inception, the day they went into the business to the day today, and if an extensive study is done as how much of the bailouts happened and how much were the dividend, and if you look at the bigger picture of the economic cost of running a bank, the taxes that the employees contributed, and bigger picture, if you take, I can vouch for you. It was not. It was not a lose-lose story. It was a win-win story. But that exercise has to be done, not been attempted, and I haven't seen it so far. If we will have to do it, I'll probably seek support, financial support to get in a professor and resources for doing it. I'll write to IB if they are willing, or other institution. I'll write. Okay. Now I would like to conclude this session by thanking both the panelists for having shared their wise counsel and based on their wide experience with all of us. I also want to thank the participants. We have spent about an hour where the participants brought in the questions and they got the best of the panelists, and the discussion was so enriched. So I want to thank the panelists also. I would like to make an announcement. Next Friday, we have another excellent webinar on developing Northeast. My own feeling is that the banking industry has great potential in Northeast. And if India has to achieve its stated targets of 5 trillion or $10 trillion economy, Northeast will have to be tapped in now and brought in. That is where the potential is. So we are going to have 2 professors talk to us, both of them from Northeast, talk to us on development of Northeast. Invite all of you to please spare some time and attend that session. In the month of January and February, we will have a session. In one of the sessions, we'll engage Professor Ram to tell us about the role of public sector banks. And in another, I'm thinking of requesting Mr. Kannan on sustainability of public sector banks. I'll keep you informed as we go ahead. And for today, once again, thanks everyone. Good night. Take care.
Thank you. Thank you. Thank you, sir. Thank you. Very nice of you.
Pleasure.
Enjoyed.
Thank you, sir. Thank you.
Okay, okay.